NetEase is no longer being judged like a fast-growing gaming company. The market is pricing it like a risky, hit-driven Chinese internet stock, but the business looks much more stable than that. Revenue is still growing, margins are expanding fast, and legacy games that should have been fading are still printing cash. The core idea is simple. This is not a broken gaming company. It may be a mispriced cash machine. What stands out is operating leverage. NetEase delivered just 6% revenue growth, but operating profit jumped 21%, which means profitability is improving faster than sales. That matters because this was not driven by a giant blockbuster launch. Older franchises like Fantasy Westward Journey are still performing at very high levels, showing this is more durable than a pure hit business. Gross margins expanded sharply, helped by lower mobile app store commissions and more cross-platform monetization shifting users toward PC. Free cash flow remains strong. The balance sheet holds large net cash, and buybacks are accelerating. This tells investors one thing: earnings quality is improving, not weakening. At current levels, NetEase looks inexpensive if the core gaming engine stays stable. The stock traded around 14 to 15 times earnings, while Morningstar's fair value estimate sat far above market price, implying heavy pessimism. But this is not cheap because nothing can go wrong. The valuation only makes sense if legacy titles remain resilient, margins continue expanding, and international growth becomes real instead of just narrative. Today's business already throws off strong cash. Future upside depends on proving this is a durable platform, not a mature gaming company slowly decaying. That is the split investors need to understand. NetEase is becoming a broader live service gaming platform with global ambitions, not just a China MMORPG publisher. The strategy is logical because live service titles create recurring monetization and stronger player retention than one-off game sales. Management is pushing overseas expansion, aiming to lift international contribution materially, while also using AI inside development, quality assurance, and live operations to improve efficiency. That can strengthen margins and speed content creation. The risk is execution. Expanding globally without Tencent-scale ecosystem power is harder than it sounds. Still, this is a rational evolution, not a desperate pivot. NetEase competes with Tencent domestically, and globally it overlaps with companies like Nintendo, Roblox, and Nexon depending on genre and monetization model. Its strength is deep live service expertise, especially in long-life franchises and MMORPG ecosystems, where switching costs are high because players invest years of time and money. It also has diversified title concentration, reducing dependence on one mega hit. Where it is weaker is platform dominance, global IP reach, and ecosystem control. Tencent is broader, Roblox owns user-generated network effects, and Nintendo dominates premium IP. NetEase wins on durability and monetization discipline, but it does not clearly dominate global gaming. The biggest risk is simple. The market may be right that this is still a volatile gaming business. If new launches underperform, user tastes shift away from its strongest genres, or regulators in China tighten again, the thesis weakens fast. AI could also reduce development barriers and intensify competition. International expansion may fail. On top of that, investors still carry China-specific structural risks, including regulatory unpredictability and VIE-related legal complexity. What breaks the thesis is not slower growth. What breaks it is if NetEase stops proving that its legacy franchises and cash flow base are durable. For upside to work, NetEase must prove it is a compounding gaming platform, not a shrinking franchise collector. That means sustained margin expansion, healthy live service retention, successful new launches like future global titles, and real overseas scaling. If that happens, investors could re-rate the company more like a durable digital entertainment business rather than a discounted China risk asset. Success looks like steady revenue growth, stronger free cash flow, rising shareholder returns, and the market finally valuing consistency over fear. This is not a high-flying growth stock, and it is not a dying gaming business either. NetEase is a cash-rich, high-margin, high-uncertainty platform bet trading. Like investors, still do not trust its durability. This stock is for investors who can handle China risk, gaming volatility, and long holding periods, but who want real earnings power underneath the story. If legacy strength holds and global execution improves, risk-reward looks attractive. The market sees a hit-driven game company. The real bet is whether this is actually a durable compounder hiding behind fear. I'll break down the next one soon. Subscribe if you want to stay ahead.